Good morning, everyone. We're going to get started in just about 1 minute. We just want to give a couple of another minute or so to let everyone in, but thank you all for joining and just give us a few seconds and we're going to kick this off. Okay, welcome everyone to today's webinar, Building Momentum. This is our second series of this great webinar series that we are co-hosting with BMO Harris Bank. Today's webinar is Decoding Your Data. And so before we get started, I just want to introduce myself, give you a little overview of what's going to happen today, and then we can get started. I am Stacey Pitts Caldwell, the Director of Small Business for the Chicagoland Chamber of Commerce, as well as the Center Director for our Illinois Small Business Development Center. And so obviously our partnership with BMO Harris is very special. We are really glad to be able to bring you this content this morning. And I think it's going to be really interesting. Today, fun fact, today is Women's Entrepreneurship Day. So happy Women's Entrepreneurship Day to everyone. This movement, is celebrated by all entrepreneurs. So we wanted to acknowledge that. And so very fitting because we have a great, a conversation started for you. A couple of housekeeping items. We will be recording this webinar, so you can, after the webinar, we will be able to send out the recording and the slide deck. There's some great information today. And I just want to introduce today's presenter to you. A little bit about our presenter I thought would be fitting to say. So Vlaka, welcome Vlaka. Vlaka is the director of BMO Harris U.S. Women in Business Banking on the business team. She develops industry-leading programming, educational content, and mentoring opportunities for women-owned business across the bank's U.S. footprint. She works hand in hand with relationship managers and small business owners, and she works with her team to provide guidance to help clients achieve their financial goals. For the past 15 years, she's been working with privately held companies to deliver innovative, industry-specific financing and cash management solutions to meet their diverse needs. Vlaka strongly believes in the advancement of women in business and entrepreneurship and has been serving the needs of this community at BMO Harris for over 9 years. She's super passionate about connecting, activating, and elevating women's entrepreneurship. So how fitting is that for today with Women's Entrepreneurship Day? So welcome, Vlaka.
Thank you so much, Stacey. I really appreciate you having me here, and I'm so excited to be decoding the data with you. Thank you all for taking the time of your day to listen to this webinar. I know in today's times we have a lot of competing priorities, and I certainly understand that you as business owners manage a lot and have a lot on your plate. So I hope you find this content valuable and helpful in making your businesses resilient and prosperous. So thank you so much again for having me. Just a quick disclaimer, this is for informational purposes only. Of course, we do recommend you go to your accountants and attorneys if you have a specific advice needed for any type of business question. Let's move to the next one. Great. So today it's going to be a full packed agenda, and we're going to try to decode the business data through following 5 C's. And 5 C's are what banks use to determine the viability of a loan deal for a business customer. And while this is something that typically banks use, I really love decoding the data through those 5 C's because I believe they provide a very comprehensive picture of not only business, but also personal health of a business owner and the business operations itself. We'll talk through some lending options and then we'll wrap up with Q&A. In understanding your overall financial position, I would like to stress that I view this almost like a health checkup. So just like we would go to a doctor on an annual basis and we would say, please check everything just to make sure everything is okay. And if something is not, please let us know what we can do to correct that and work on that. I view the financial position and financial health in the same way. It's really important to take a full picture and gather a comprehensive understanding of a financial position. That includes personal credit history, and which shows the credit worthiness and suggests a sense of financial responsibility. Thoroughly understand your financial statements, which are like the financial dashboard of your business. They give you a good picture of where the money is going, where it's coming from, and how much do you have to work with. And the third one, which is definitely not the least important one, and I think in today's time, we realize that it's actually one of the most important factors. Well, it's important to understand your personal performance and business performance. It's extremely important to understand the industry and economic conditions that surround us. And as I mentioned, during these times, we have never seen this being more important. Even in absence of COVID and health pandemic, we should still be looking at external factors to make sure that the industry we're operating in, that we're trending, that we're acknowledging all the trends that are happening. And for example, we can have a industry that's going through a lot of consolidation, such as insurance brokers. So we kind of need to understand that so that we can properly strategize and project our goals for the future. So all of those three elements will give us a comprehensive understanding of a financial position. So moving on to 5 C's. So today we'll talk about character, capacity, capital, collateral, and conditions. If we understand those 5 C's, we'll really understand how we're doing both in our personal and business lives. And we're going to understand how we can potentially use the information from our personal credit history as well as business financial statements to support our future goals and to adjust our business to make sure that it's growing in the right direction. So I'm not going to go through all of those at this time. We're going to deep dive into each one of those as we go. So our first one is character. So as I mentioned in the beginning, character is very important for us as bankers. And it is a way that bankers determine credit worthiness of a business client. And while it's always important to have a great personal credit history, it becomes increasingly important when we're trying to make bigger purchases, whether those are buying a home, buying a car, doing an investment in our business. That's typically when most of us actually start thinking about our credit history and what our credit report would look like. But I would really encourage everyone to establish almost like a continuous monitoring of your credit history to make sure that we are catching all the things that we're supposed to catch on a timely basis. And a great way to be monitoring your personal credit history is to obtain a free credit report. There is a free resource at annualcreditreport.com. That's actually a resource provided by 3 major main credit reporting agencies. And they allow for an annual credit report to be pulled. I believe in the COVID times, they not only allow for a credit report to be pulled once, you can actually pull it more frequently. And the reason why this is important is because we want to make sure the information on there is accurate. Address, all of those address information on the credit cards that you have, past history on repayment of mortgages. You want to make sure that all of the information contained in the credit report is accurate. because you don't want to be at a point where you are making a major decision and then you uncover those things. If you uncover those things as they happen, and if there is for some reason an error, then you can act upon it and you can actually fix it timely and not worry about it when you are ready to make a major purchase. It is also important to, a lot of people actually ask about credit scores. And I want to bring some attention to that too. So credit scores are a great measurement to see where your credit history is at. And I think a lot of us want to have something tangible that we can look at and that we can understand how that correlates into our credit history. But I would really caution on just focusing on the credit score. Well, credit score is important. It does vary between the 3 reporting agencies. Each financial institution may have slight differences in what they consider to be good versus poor credit score. But it's also important to review your report for any negative events. So charge-offs, debt collections, bankruptcies, foreclosures, tax liens, judgments, those are also being reviewed by external companies when you are having your credit report pulled. So it's not only important being focused on that score, it's truly important understanding your historical performance on that. It is also important to know that pulling a credit history, pulling a credit report in today's times is important for fraudulent transactions. Unfortunately, COVID did kind of, with everybody being online, there has been a slight increase in fraudulent transactions that happen on online. So we just want to make sure that we know what's on our credit report, because if we see a credit card that we did not open and somebody else opened, it could potentially negatively impact our credit history and credit score. So we want to make sure to address any kind of fraudulent transactions or actions by other people as soon as we can. I mentioned you may see some discrepancies or errors on the credit report. They're not, sometimes they're not perfect. And if we are continually monitoring our report, we have a way to actually dispute those credit errors, and Federal Trade Commission does provide steps on how to do that, as well as a sample dispute letter that's tagged in this presentation and linked. So you can link to the sample dispute letter to see how you can dispute any potential inaccuracies on your credit report, because you definitely don't want to have that on your credit report for a long time. You want to make sure you're addressing those fairly quickly. So moving on to the next one. So how can we improve our credit history? So I'm sure if you look at these, some of these steps that we're presenting online, a lot of those are I'm sure you're doing a lot of those and you're aware of a lot of those. The ones that stick out to me is, it's actually unused credit cards. So I'm sure if you're like me, or I'm sure you have some credit cards from when you were 20 and you were trying to build your credit, and you opened some credit cards just to start building your credit and showing that you do have a credit history once you're able to apply for a loan. Well, actually, it's not recommended to you close those unused credit cards, because you are decreasing the limit that you have on your total amount of credit availability that you have. So it's actually not recommended to close a lot of your unused credit cards, simply because you're decreasing the overall pool of credit that's available to you. And then if you do have debt on the credit cards, that debt is actually a bigger percentage, because you're decreasing the availability, so it can potentially negatively hurt your credit score. So that's definitely the one that sticks out to me, and the one that a lot of people are not aware of. Another one that sticks out to me is actually being careful with the high levels of debt on the credit cards. So there's no a perfect calculation that would tell you how exactly can you manage your credit to get to a certain credit score. But for example, if you have a credit card with a $10,000 limit And if you're at a $9,000 for a particular month, that can potentially negatively impact your credit history being so close. So even though you paid that $9,000 post your every month, we never want to be too close to that credit limit. We want to make sure that our percentage of the used credit versus available credit remains low. Another one is just not paying traffic tickets or medical bills. Some of those things, utilities at the time, could negatively impact. Applying for too much credit with too many creditors at the same time can also negatively impact. So those are all steps and useful tips we can take to make sure that we're monitoring our credit on an ongoing basis and truly being mindful of the steps we're taking in our everyday personal and business lives to make sure that we're not negatively impacting the credit.
Hey, Vlasta, and are you okay? I just want to let everyone know that they can go ahead and submit questions because this is such great information. We want to make sure we're capturing everyone's questions. So if you have questions, please just throw them in the chat.
Thank you. Thank you, Stacy. Yes, absolutely. We want to make this as interactive as possible. So the second one, when it comes to character, so we talked about the credit history because it is a tangible way to kind of measure the past credit repayments of a borrower, but it's just as important to take management and other industry relevant experience into an account. I think that's just as important when assessing character. So for example, I used to have a lot of clients who were starting their business and they have never been a business owner before, but they have this wonderful 15-year experience in the industry in which they're starting their business. So that definitely counts. That definitely carries a lot of value. That historical experience in the industry, historical experience in managing a business is very important when assessing character as well. And it's important to surround yourself with a good team of experts. I do believe that we all need that good, supportive, collaborative network around us, people who truly want to help us succeed and to provide guidance and advice, especially in tough times, such as like the times that we're in. I think having people around us with our best interest in mind does help with our overall performance as well. Okay. So that's on credit, and we'll take some questions on that later on. Now we'll deep dive into capacity, and here we'll spend a lot of time because in order to understand capacity, we will need to understand key financial statements because those are the statements that we'll be pulling some information to understand the capacity and what capacity means in the banking world and how that impacts the business. So the three financial statements that are key for any business owner are balance sheet, income statement, and cash flow. And we'll start with balance sheet first. And they're not listed in any particular order. I do believe just like assessing your personal history, your financial business credit, business history and financial performance and external factors and making a puzzle of that and understanding all of those pieces of the puzzle, I feel exactly the same about the financial statements. I feel like we can only get a good view into business financial state if we take a look at all three of those statements. So we'll start with the balance sheet. And balance sheet is pretty much a snapshot of a business condition at a point in time. Balance sheet is established when a business is started up and it follows you through your business life. It shows current and long-term assets, so what the business owns. It shows current and long-term liabilities, what the business owes, and how much equity does the owner have in business, which is presented in owner's equity. It's a very useful tool that banks definitely look at to make sure that the business is properly balanced. We certainly always want to see more assets than liabilities, but we do understand that sometimes the distribution of assets and liabilities may change. For example, for a starting business, we may see less in assets and more in liabilities because you are starting the business and building it. And there are certain things that need to be built up in order to be at a point where your assets are higher than liabilities. And we may see in some other instances with, for example, business that's being ready for sale, we may see another view. So we may see a lot more assets than liabilities in that particular situation. Where I would caution on balance sheet is just to make sure that we're looking trends over time rather than a point in time. And I'll explain why. So as the business progresses and there are certain goals that are put in place, we want to make sure that we're checking those financial statements, that everything that we're trying to achieve in our business is reflected in the financial statements. So if our goal is to build up cash in the business, then we need to look at that historical trend in building cash to make sure we're trending in the right direction. If our goal is slightly different than that, then we need to pay attention to that specific metric. Now, for some, it's also important to look at balance sheet at different points in time because of cyclicality that a business may have. So let's look at a holiday store that's probably getting to be extremely busy during these times because we're getting close to the holiday season. You may see a balance sheet of a holiday store very low in inventory, very low in cash during summer or spring months. But you may see a completely different balance sheet view as we get close to that fourth quarter. So we get close to October, November, December, when that inventory is starting to pile up because the store is preparing for adjusting their inventory levels for the influx of sales that are about to happen. So it's very important to understand your business and cyclicality that your business may have, and make sure that we're looking at the balance sheet at points in time where our sales are occurring, as opposed to always checking our slow periods. So one of the most important ratios that's related to balance sheet is actually a working capital ratio. And if we flip to that slide, we're going to go over the calculation of the working capital ratio. So I mentioned that the balance sheet shows what the company owns in terms of current assets. And let's talk about current assets a little bit. So current assets are very important for a business. Those are assets that can be converted to cash in less than 12 months. So in less than a year, anything that can be converted into cash, such as accounts receivable. If you're selling your goods on credit to your customers, I mean, most of those should be paid well within 12 months. I mean, not even close to 12 months. Hopefully the repayment terms are much shorter than that. So those are considered current assets. It's also any cash is a current assets, accounts receivable, inventory is a current asset. So those are current assets that a business may have. Long-term assets present items such as buildings that our business operates in. If we own a building for our business, it can be a more expensive piece of equipment, or it can be some kind of investment that cannot be liquidated in 12 months. So those would be considered long-term assets. On the flip side of things, we have current liabilities. So those are liabilities that we are expected to pay with cash over the next year or over the next 12 months. And those can be accounts payable to our suppliers. They give us certain terms within which we have to pay for our payables. And those are typically 30, maybe 40, sometimes 60 days, depending on the agreement with the supplier. Wages payable is another current liability because it certainly needs to be paid in way less than 12 months. So those are considered current liabilities. Long-term liabilities would be a liability such as a long-term loan. So if we have a mortgage on the building, that's considered a long-term liability because it doesn't need to be repaid within 12 months. It actually needs to be repaid within 10 or 20 years or whatever the amortization of that loan is. So those would be considered long-term liabilities. One of the ratios that's extremely important for the balance sheet is actually that working capital ratio, which shows you how current assets that you have could cover your current liabilities, whether a business will have sufficient current assets to cover their current liabilities. And we have a calculation presented on the right side of the screen where it shows if current assets, so our cash and accounts receivable, are equal to our current liabilities, then we're at 1. And that's the minimum ratio, minimum point where we should be at. If we're less than 1, then we may be facing a shortage of those current assets. We may not have enough current assets to cover our current liabilities, and we may have to resort to some other financing sources. Some businesses have a working capital line of credit where they, in case of a cash shortflow, they would draw on that line of credit to make sure they're covering that very short-term shortfall. And then once those accounts receivable come in and the cash comes in, they can pay that portion off. In absence of a line of credit, businesses can use credit cards. Those are at a slightly higher interest rates. They can go to other sources of capital. But I think it's important to really understand where the business is at, and we'll go through that a little bit more in our cash flow discussion to make sure that we're not blindsided by the cash flow shortfall and working capital ratio being less than 1, because then we may be reaching a situation where we have to resort to more expensive forms of capital, which we always want to avoid. In the best case scenario, the business could cover the business current assets, could cover business current liabilities with no external assistance. But we just want to make sure that if there is a need for that, we do have a affordable way of dealing with that and not putting the business in jeopardy. Sometimes I would just mention for a startup, sometimes we may have a ratio less than 1 until those collections normalize and they start rolling in. So it just depends in what business cycle a business is in, whether it's a new business, established business, maybe business is growing and there was a lot of investment in a product or a service. In that case, we may have that slight shortfall that's very temporary. We just need to make sure that if there is such a shortfall, there is a plan in place on how to address it in an affordable and an efficient way. Okay. Moving on to our next financial statement that we'll talk about, income statement. And I look at the income statement almost as a report card for the business. So it actually tells us how well a business is doing. And it's something that I definitely encourage business owners to pay attention to at least on a quarterly basis. I mean, in some instances, we may have to pay attention to it on a monthly basis, sometimes quarterly. Some businesses take a look at it annually, although I probably wouldn't recommend annually, especially for a growing business or a business that's changing their direction or changing their strategy. I would definitely recommend staying on top of income statement slightly more frequently than on an annual basis. So what income statement is going to show us is revenues. So what are our main sources of revenues as a business? Are they coming from a sale of a product or service? Are they coming from another source that we have? So how much of our revenues are coming from each source? And once we know that, then we can actually adjust our operations. If we see that maybe we are selling a product, but all of a sudden we started selling a complementary service and that revenue has been going up. So maybe we can adjust our strategy of our business to make sure that we sell more of that service and make more revenue in the service space as well. So it's a good indicator of showing us where the revenue is coming from. It shows us expenses. So it's extremely important for monitoring expenses and where those expenses are coming from, whether they're those fixed expenses we have to do and variable expenses that we have as a business, where are those going and how does that impact the business? And then overall net income, that's kind of like the our scorecard score, like net income, how much net income is left in the business once all the bills are paid, how much money is left for the business to grow. And ultimately that's reflected, which is earnings before interest, taxes, depreciation, and amortization, which is pretty much a measure of profitability. So income statement does provide a lot of granular details on our revenues, expenses, and measures our profitability, which is extremely important. Now, I would also remind all of us to pay attention to trends and percentages. What I like to do with income statement is actually convert numbers that we see in terms of revenues and expenses and net income and EBITDA into percentages. And then I know, for example, we have wages, and I'm in the insurance business, and my wages are the main cost that I have, and those can represent 60% of my overall expenses that I have as a business. So 60% of all of my revenues are going to pay for those wages. What I encourage you to do is compare those costs that are expressed in a percentage to industry standards. So if an industry standard is 60% of your expenses should go to salaries and wages, then we're trending in the right direction. If we are in an industry where an average percentage that should be spent on wages is 40% and we're 60%, it's just important. It's not saying that it's wrong, but it's important to understand why are we so far off the industry standard? Why are we spending a little bit more on our salaries than maybe our industry peers? Maybe we have a different value proposition. Maybe our sales force is a little bit different, but it just helps us compare and understand where we are. Same for rent. Some businesses spend events businesses a lot of times. Some of them, if they have call, a huge portion of their expenses can be allocated to a building if they own it, if they own some space where they hold their events. So we want to make sure that that's looked at as a percentage of revenue. That it's looked at over time to make sure that it's not going up. So you don't want to see your expenses going from 40% to 60%. So for example, you have rent payment and all of a sudden it goes from 40 to 60. I'm not saying that's necessarily wrong, but we need to understand what caused that huge jump. So those trends over time are more important than just looking at plain numbers in isolation and not comparing them over the previous periods or not comparing them to your industry peers. So definitely very important. And then profitability, how much money is left for the business to grow? Extremely important, especially for growing businesses. We want to make sure that we are putting as much money in to the business. If our strategy is to expand and grow and diversify, then it's important to have that net income higher to make sure that we're leaving money in the business. And now we'll actually look at a tool, that we have that can be used to improve the profit. So BMO Harris has developed a number of different tools that can support business owners throughout their financial journey. And we have some startup tools, some some growing your business tools, some cash flow tools. And one of the tools that's particularly interesting when we are looking at our income statement is Profit Improvement Calculator. So how can we improve our profit? How can we and how does that improvement, like in each one of these categories, how can that reflect in the overall profit? So for example, this calculator is pretty easy to use in terms of putting number of potential customers. So let's say we have 100 customers that come into contact with our business each year. And those can be customers coming through web traffic, phone calls, customers passing by, direct visits, repeat customers. So we would put the number that we have today. Let's say we want to improve that number because we all want to have an increase in the number of customers that come through our business. And we want that improvement factor as 10%. We can input this number in and see how that would impact our profitability. Now, increasing a number of potential customers is great, but we also want to make those customers actually buy a product or a service that we provide. So conversion rate is just as important. And we can also estimate that if our conversion rate of every single customer that walks in our business is 10% or 20% or 30%, maybe we estimate that if we improve it by 5%, what kind of impact that's going to have in our overall profit. And we have seen a lot of customers running campaigns, improving the chance of conversion, maybe trying to launch some informational videos, all for with the goal of improving that conversion rate and having that customer who truly wants to buy your product and service and is buying them, buying those products and services on a continuous basis. Transactions per customer is also another item that we can see if we can improve, because it definitely helps with a profit part of our equation. And this is where we can think about maybe adding complementary products or services, or partnering with another business. And I'll just mention a recent example that I came across. I ordered some baked goods from a bakery, and because in these COVID restriction times, I did it online because they're just available for pickup. But when I went to the website of the specific bakery where I was ordering baked goods, I also saw flower arrangements. And I'm like, wow, I didn't know that this particular owner sells flower arrangements. But actually, this particular owner partnered with a local florist shop, and she not only offered cakes and wonderful baked goods for Thanksgiving, but she also wanted to make sure that she offers something from a partnering business. And it's creating such a positive experience for the customer, because I was so happy that she's supporting another business. I was really thrilled to see that in these times, it has never been more important for us to support each other, for us to support our businesses. And that actually created a good feeling in my mind. And I immediately ordered a floral arrangement, because I'm like, you're doing something good. It's a beautiful floral arrangement. You're you're actually saving me some time, cutting some time from my schedule to do that. But you're also helping your fellow business owners. So I thought that was wonderful. And I think that those kind of things, especially today, do create loyalty. So average value of each sale, if we can increase the average value of transaction, that would be great. It's a huge impact to the profit, to the bottom line, and then net profit percentage. So those are the things that you can play around with. And I would definitely try focusing on more than just one. I think if we have all of those elements working together, maybe not in the same percentage, this is for an example purposes only. So maybe not all of them have the same improvement factor, but if you play around with those numbers, you can see on the bottom line what kind of change that can have on your profit. And then maybe when you see that change on your profit, you can determine, oh, I think I should focus on adding complementary services, or maybe I should start converting more customers. So providing more educational content with the product to make sure that I'm creating those loyal relationships with my customers. So you can see how much each improvement factor would actually impact this bottom line that it's in the last row on the page. So it's a really good tool to play around with and project and think and strategize about your business. Okay, so moving on to the next one. Oh, great, cash flow. So I mentioned we didn't put balance sheet, income statement, cash flow in any particular order. Those are all three important. Cash flow is just as important as the balance sheet. Just because it's third on the list does not mean by any means that it's the least important. It's actually really important. So cash flow shows the inflow of cash into the business, inflows and outflows of cash. It shows operating cash, so cash that we are generating from our operations, which in my mind is the most important cash that we have, investing cash, and cash obtained from financing activities. So cash obtained from line of credit or other sorts of financing activities that we have. So it's an extremely important, cash flow statement does not measure profitability. So it's not going to tell us how profitable business is, but it will tell us if the business has sufficient cash to pay their bills. And that's extremely important for the business. And I think it was extremely important during these really, really tough times when businesses were challenged with so many different things to pay attention to. And now with cash flow, it's important to project. This is one of those things that it's important to, just like the balance sheet that we talked about working capital, if we move on to the tool, Remy, I can kind of walk through the tool. So we also have a tool called Cash Flow Forecast tool that shows that actually, so this tool allows you to enter projected sales and other revenues each month. And then by entering those expected incoming receipts that you'll have a better idea of what's coming. From there, you can deduct your expenses to see if you'll have enough cash in hand, or you need to work out a way to pay your bills through another source. And the way that businesses do project cash flow, they use last year's sales or maybe current sales history. I know this year it was really hard to use last year's sales because we were faced with unprecedented times. So we needed to, like, all of our past year's sales history really didn't correlate to our current credit sales history. So, but maybe it's a good tool to estimate where there could be a potential shortfall. And not only is it good to project so you can see, and it allows you to enter your bank balance on the bottom. So if your bank balance is $10,000 and you have, in this case that we just did plugged some numbers for illustrative purposes. And as you can see, our cash balance ended up, we made some money, we had to pay some money out, we had to take some cash, but then we also ended up with this bank balance, and that balance will grow and decrease depending on our inflows and outflows of cash flow. This tool is great tool for projecting. So in these times, and actually business growth times, I'm sure a lot of business owners were wondering, what would happen if I hire a full-time salesperson? Or what would happen if I borrow money? Can my business really support that? Or what would happen if I bought a new piece of an equipment? So it can be maybe a little bit more, a little bit better software or a point of sale or something that I need to invest money to. How would that impact my business? Well, this tool actually allows you to play around with some of those changes and assumptions and shows you what kind of impact that would have on your business. So it would show you if you put a repayment of loans, let's say you do get a loan to just support your growth, you can put a loan payment in this cash flow tool and see if you would have sufficient cash based on your assumptions to pay for that loan. It would also give you a good idea of whether you can have staff changes on your team. So for example, if your staff wages, we put $3,000 here, let's say we add another person and double that amount, would the business support that? So we do feel that this is a valuable tool for planning of existing business and for projecting next year, making sure that we're staying on top of that cash flow, because cash is king in any business, but also making sure that it allows us to project any type of changes that we're considering.
Hey, Vlaka, we have a question. The question is, it says, do you all take into consideration businesses that started during or shortly before the pandemic and have been able to endure it? Because obviously their cash flows look completely different. And so from a
Yes.
long-term perspective, is that going to be something that's going to be taken into consideration?
Yeah, so that's a great question. So in a traditional banking world, let me start by saying this. I have seen a number of wonderful business owners actually start their business in the middle of pandemic. And there's nothing that makes me happier than seeing that somebody truly pivoted or decided to take a leap. And I mean, these are hard times, but there's nobody braver than you as business owners. So I really have seen a lot of women business owners and male business owners start their businesses, and they should be very proud of themselves. And I think it's great that they're doing it. And I think that's what the economy needs. The economy needs brave people, and the economy also needs us to support you, brave people who are starting businesses. In a traditional banking world, we do need to have a 2-year history in order to be providing lending. But we do have some other institutions and organizations that we work with. And I would be more than happy to take that offline and answer that, have a really good advisory conversation and provide some resources that we have for startup businesses. Because there are some, but traditionally banks do want to see that 2-year history. Great question, really great question. Awesome job starting a business. I hope we all support it and we all do our part in making sure it's successful. So back to our capacity. So now that we went through our balance sheet, income statement, and cash flow, so three major financial statements that a business owner should pay attention to. And we also talked through working capital, profit improvement, and cash flow projection tools. Now we can talk about capacity. So capacity is one of the most important ratios that banks use to determine whether there is enough income to pay the loan back. So it's a very frequent calculation. I think if we understand the calculation, then when we are coming to the bank, it makes us a better borrower in terms of like, we know exactly how to ask that question. So I think I always wanted to really understand this part to make sure that when I go to the bank, or if I were a business owner, I would definitely like to understand this one. So banks combine personal and business income to determine if there is enough income to pay the loan back. So they take personal income in wages, other types of income that may be coming in, and then they take out all the personal expenses that we have to come up with that net personal income. So how much income do we have once we pay all of our bills? And once we receive all of our personal income, how much money do we truly have to support the debt? We do the same thing on the business income side. So we do take into account business income. And we start with net income. We will add back those non-cash items. So items such as depreciation, amortization, those things are going to be added back to the business because those are considered non-cash items. So once we have that personal income and business income, we have a good starting point on how much income in total a business has to support the debt. And then we divide that by principal and interest payments that a business would have to make. Now, the goal is to be at 1.25. And when I say 1.25, it means that for every dollar of debt that a business has, there should be $1.25 of income available to service it. So the banks typically look at that as slightly higher, so not as one-to-one, because if we have enough income coming in just to pay for, once we take all the expenses out to pay for debt, it's good because it's one-to-one, but it doesn't provide that cushion. And that cushion is extremely important. Things can change in the business, things can change in the economy, things can change in the industry. So that extra 25 cents represents a cushion to protect against economic downturns. And that's extremely important to take into consideration. So from all the banking debt service calculations, I would I would definitely say that this is one of the most important one because it determines the capacity of the business to make its loan payments. Okay, so we'll dig into our three last C's: capital, collateral, and conditions. And capital is viewed as cash or equity in the business. It's similar to a down payment. It's good business sense to put some cash or equity in the business. It's a down payment when we're starting our business. So we definitely want to make sure that we're checking to see what capital is provided by the owner into the business. And it's especially important during an economic downturn or business growth because that capital can be used for any type of downturn situations or for business growth. Maybe we want to grow the business and use some of that capital for growth. Capital is a great way to do that. Collateral is important to a lending decision. It's a secondary source of repayment. As we mentioned in the capacity, it's definitely the most important thing is to pay attention to personal income and business income. This is just if unable to pay the loan, business owner, then there is a possibility that the bank will consider using the collateral as a source of repayment. But I would definitely stress it's a secondary source of repayment. The first and primary source of repayment is always business and personal income. That should always be our starting point, what we focus on. Collateral is just in an event of an unfortunate circumstances that may impact the business. Conditions, just like we talked about external factors in the beginning, conditions are extremely important. We have seen COVID-19 across different industry types, and we have seen a lot of variations. Some businesses have been very negatively impacted, while some of the online retailers have been stable due to increased demand. So just understanding those external factors and conditions is extremely important to the bank and to the client, and I think it provides a good overview. So with this, we wrapped up character, capacity, capital, collateral, and conditions. And this gives you, if you approach your business from that 5C perspective, you will not be missing any important pieces. You will truly have that comprehensive view into your personal and business financials.
Sorry, I was just going to throw one more tool in the chat. It's the loan calculator. About it, so to let everybody do that. And then I just want to do a time check. We've got about 8 more minutes, and there's a couple of questions. So let me know when you're ready for questions, Magda.
Okay, sounds good. So I'll just go quickly through financing options and that are available and most common. So there are many financing options that are out there for accounts receivable and all of those. But what I'm going to do, I'm going to go through the 2 most frequent ones. And one is revolving line of credit. And that's the one that we actually mentioned in the cash flow conversation where we talked about if for some reason, let's say our accounts receivable days are 45. So it takes 45 days for our customers to pay us for any services or products that we sold on credit, and it takes them 45 days. But we have to pay our suppliers in 30 days. Well, that creates that 15-day gap. And if we have that happen in our business cycle, then we may have to tap into that if we don't have enough cash built up in the business, or if we just we're growing faster and we're offering different terms to our suppliers versus customers, we may have to use that working capital line of credit for a business. It doesn't typically, maturity is less than a year or no maturity, interest only payments, variable interest rate. It gets drawn upon and then paid back. So it's always important to pay it back once the cash does come in, to make sure that you're not constantly incurring that interest, because it's causing an expense. So it's important to, if you draw on it, to draw on it when the time is right for that, but also to pay it back once those accounts receivable come in. Non-revolving line is slightly different in terms of maturity. Typically is done for a project. So it's more for construction. So if we know that we're building maybe a location and it's going to take us 24 months to do that, then we would give a revolving line of credit for 24 months. And that revolving line of credit would actually be drawn upon as the location is being constructed. Term loans are used for larger purchases such as business equipment, larger business equipment, real estate, and those have longer terms that can have amortizations up to 25 years, up to a 5-year term. And those are like a mortgage payment in terms of amortization, principal and interest, and they can have fixed interest rates for a term of the loan. Interest rates will vary on the index that the bank uses. Prime rate, LIBOR is kind of phasing out. So prime rate or treasury rates are probably the most frequent. Perceived credit risk. A lot of banks have risk-based pricing, so it will just depend on that. And then the length of a loan. And if we move on to the next one. Okay, I don't know if we have time for scenarios. We actually had a scenario, so maybe I'll go. So this one, business owner walks into a branch, they typically receive payments, and that's the kind of scenario I talked about. They receive their customers pay within 45 days, but they have to pay suppliers for 30 days. That'd be working capital line of credit. And then the next one, business owner walks in, she would love to buy a building, which she will occupy at 50% capacity, which will consider it owner occupied. In this case, what product should be used? Mortgage term loan, because she's buying that long-term asset. So we always want to make sure we're pairing up long-term asset with long-term financing, short-term assets such as account receivable with a short-term financing. We don't want to mix the two because then we're creating a discrepancy. And if we move forward, a loan calculator was just sent. It's a tool that can help you estimate your loan payments and play around and maybe put those payments into the cash flow tool to see how it would impact the overall business. It gives you amortization, so how you're paying off your loan over time. So it's a great tool to have. And top 3 takeaways: please monitor your personal and business financial health. I know it's hard. I know you're managing a lot. I applaud you for the bravery and everything you're doing. You guys, you're doing a tremendous job, especially in these times. So, but if you get a chance, and please monitor, especially nowadays, to make sure there are no errors, fraudulent transactions, and so that you know if there is, for example, an expense that it's kind of going out of the range that you would like it to be, then you can at least address it on a timely basis and not catch it like 6 months down the line or 12 months and it's causing more financial harm to your business. Seek out educational tools and resources. We're here to help. Please consider us, and I'm combining the third point too, a network of trusted experts, mentors, and advisors. We're here to help. We want to help you. Just as it's important to have an accountant and attorney, it's just as important to talk to your banker as well. Please, we want to have you succeed. If you succeed, we all succeed. So it's in our best interest to have you guys succeed and to have your businesses prosper, because then we all prosper. So we're happy to help. Reach out to us. There's no people really want to help, especially nowadays. So I really encourage you to do that. We have our Women in Business email box and that we're monitoring. We would love to hear from you and see how we can support you and help you. And whether you are a woman or a business or not, we're gonna help you as much as we can. We have our BMO Harris Women in Business site, and then we have Business Insights page as well with all the tools. And we highlighted 4 of them. Actually 3 of them, but we have many more on the Business Insight tool that we have available too. Thank you so much. I think that wraps it up. I'm sorry, I'm at 2 minutes for questions.
No, I think that's okay. This was really great information. I just had one question that was a direct, that was sent to me directly, and that was for micro businesses, which are really small businesses, maybe just one owner, maybe just one person on payroll. Is it better to pay expenses and maybe, accounts payable directly out of their checking account, or should they use like a credit card credit to preserve sort of the cash flow?
So that's a great question. That's a really good question. I would definitely say for that one, it depends on the cost. So a credit card is great, but a credit card also carries a pretty high interest rate if not paid in another month. So I don't think, whereas if there is enough cash in the business and there is no potential growth, I always support businesses to use their own cash, but it cannot be looked in isolation. It really depends whether there's going to be enough cash next month and the month 3 and the month 4, because all of those months will impact your month 1 decision. And that's why this cash flow calculator is a great tool, because you can actually see how that would impact your balance. So if you have $5,000 in the balance, you would see if you take out 4 to pay for something, how that would be impacted over a month. So I would definitely look at that one to incorporate other expenses and to make sure that you're understanding the overall impact on the business.
Okay, that makes sense to me. I think I know we're right at 11, so I just want to thank everybody for attending today and just remind everyone that we will be sending out a post-webinar email with all of the information, the slide deck, the links, and contact information. And also remind you that you as a small business owner have advocates. You can schedule a one-on-one advising session with the Illinois Small Business Development Center, which I oversee, and I have a team of advisors to help you. So you can just, go to chicagolandchamber.org/SBDC. And thank you so much for attending today, and have a great week.
Thank you so much. Stay safe and healthy, and I wish you all the best. Please reach out with any questions. Thank you, Stacy.
Thank you.